In this TaxLayer Pro presentation, we'll discuss 10 things to know about the upcoming tax reform. Your clients have probably already been asking, tell me about the new tax law. If you recall, on the Friday before Christmas, President Trump signed the new tax reform bill into law. So, for individuals, the tax reform bill took effect on January the 1st, 2018 for income earned starting in 2018. If we get a tax cut, we probably won't see the overall results until we file this year's taxes for 2018, which will be due in April of 2019. Of course, the tax returns we filed not too long ago were for tax year 2017. People who work a regular job and have taxes withheld from their paychecks have likely seen a change in their federal income tax withholding. This probably started back in early February. For a taxpayer who gets a $1,000 tax cut, this could mean an extra $38 or so per paycheck if you get paid every other week. Those receiving a $2,000 tax cut may see an increase of about $76 per biweekly paycheck. Of course, the amounts can vary depending on your personal circumstance. There are some new tax brackets. Among the main changes are the new tax brackets and elimination of some itemized deductions. In general, the new tax rate structure means lower tax brackets for most filers, with the top rate dropping to 37% from 39.6%. The 10% bracket now extends to almost $10,000 for individuals and $19,000 for joint filers. This doubles the amount of income taxed at the lowest rate. The standard deduction has also been doubled. The corporate tax rate has dropped from 35% to 21%. So now let's talk about the 10 things you need to know about tax reform. Number 1, the new standard deduction and repeal of the personal exemptions. The new legislation temporarily increases the amount of the standard deduction to $24,000 for married individuals filing a joint return, $18,000 for head of household filers, and $12,000 for all other individuals. A quick comment on this. For the 2017 tax year, the standard deduction for single taxpayers was $6,350. So, in other words, we won't get to use the newly passed $12,000 standard deduction until we file our 2018 taxes in April of 2019. Likewise, married couples filing jointly will see a bump from $12,700 to $24,000, but that won't impact their household finances until they file their returns in April of 2019. The new legislation indexes the standard deduction for inflation using what's known as the chained CPI, Consumer Price Index, for taxable years beginning after December 31st, 2018. The new law temporarily suspended the deduction for personal exemptions and modified the withholding rules to reflect the fact that taxpayers no longer can claim personal exemptions. A comment on this? All right, so just what is chained CPI? What does that mean? Without getting too far down in the weeds, the chained Consumer Price Index is an adjustment that accounts for the fact that consumers tend to shift their purchasing behavior as the relative prices of items change. For example, when the price of Granny Smith apples increases, people may buy Gala apples instead. As a result, chained CPI shows a slower pace of price gains or inflation than traditional CPI. This chained CPI provides an estimate of changes in the cost of living from one month to the next by using what are called market baskets from both months, and this chains the 2 months together. Okay, back to the new standard deduction and repeal of the personal exemptions. The new law provides that the IRS may administer the withholding rules for taxable years beginning before January 1st, 2019 without regard to the amendments made under the new law. This means, at the IRS's discretion, wage withholding rules may remain the same as under present law for 2018. The IRS is currently reviewing the withholding provisions and is attempting to make an easy transition for employers, employees, and payroll service providers. Number 2, deduction for qualified business income. Individuals who are sole proprietors, partners in partnerships, members in LLCs, taxed as partnerships, or shareholders in S corporations may be eligible to claim a deduction for qualified business income, or QBI, under the new Code Section 199A, beginning with the 2018 tax year. Trusts and estates are also eligible for the deduction. The deduction is 20% of what's known as qualified business income, or QBI, from a partnership, an S corp, or a sole proprietorship. QBI is the net amount of items of income, gain, deduction, and loss with respect to a trade or a business. The business must be conducted within the United States in order to qualify for this 20% deduction. And a comment on this. Instead of lowering the tax rate on all pass-through businesses, the final bill allows pass-throughs to deduct up to 20% of income. Most personal service businesses are S corps, so how much you save is dependent on how much of your S corp is comprised of salary versus pass-through income. Since an attorney or realtor has to take a salary, the 20% deduction is only applied to whatever amount of income is left over as specifically the pass-through portion. The graduated tax rate structure for corporations, featuring a top tax rate of 35%, is being replaced by a flat rate of 21%. As a result, the overall tax liability of many C corps will be reduced. For example, Sally is a small business owner with a Schedule C, and she makes $100,000 from her business. Sally's taxable income is $70,000. Sally's Section 199A deduction is 20% times $70,000, or $14,000. Section 199A deduction is also known as the Qualified Business Income Deduction. Another example. In 2018, David receives $100,000 in salary from his job at the Acme Corporation and $50,000 of qualified business income from a side business that he runs as a sole proprietor. David's QBI deduction for 2018 is $10,000, or 20% of the $50,000 earned as a sole proprietor. Let's look at a definition very quickly of qualified business income. Qualified business income, or QBI, is determined for each qualified trade or business of the taxpayer. For the taxable year, QBI means the net amount of qualified items of income, gain, deduction, and loss with respect to the qualified trade or business of the taxpayer. Looking at the treatment of investment income, qualified items don't include specified investment-related income, deductions, or loss. Specifically, qualified items of income, gain, deduction, and loss don't include any item taken into account in determining net long-term capital gain or net long-term capital loss. These items don't include dividends, income equivalent to a dividend, or payments in lieu of dividends. They don't include interest income other than that which is properly allocable to a trade or business. And looking a little further at the treatment of investment income and those items that are not included, the excess of gain over loss from commodities transactions other than those entered into in the normal course of the trade or business, or with respect to stock in trade or property held primarily for sale to customers in the ordinary course of the trade or business, property used in the trade or business, or supplies regularly used or consumed in the trade or business. The excess of foreign currency gains over foreign currency losses from Section 988 transactions other than transactions directly related to the business needs of the business activity. And finally, these qualified items of income, gain, deduction, and loss do not include net income from notional principal contracts other than clearly identified hedging transactions that are treated as ordinary, for example, not treated as capital assets, and any amount received from an annuity that is not used in the trade or business of the business activity. Going back to our qualified trade or business definition, a qualified trade or business means any trade or business other than a specified service trade or business and other than the trade or business of being an employee. So what is a specified service business? Well, a specified service trade or business means any trade or business involving the performance of services in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services including investing and investment management, trading or dealing in securities, partnership interests, or commodities. Any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees is a specified service business. Owners of rental property are entitled to take the Section 199 deduction. And just a comment on this. Some of the categories and fields listed in the previous bullet points are clear in their meaning. Others, such as consulting and any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees, they're vague and they'll be difficult to apply until the IRS provides us with guidance. So let's look at specified service business and eligibility for the 20% deduction. A taxpayer whose income falls under the threshold amount or amounts $157,500 for single, $315,000 for married filing joint is entitled to use the Section 199A deduction even if the taxpayer's business is a specified service business. The threshold amounts, the $157,500 and $315,000, will be annually adjusted for inflation. For example, Steve, an unmarried CPA, has a practice where he earned $100,000 during the tax year. Assuming Steve's taxable income is under $157,000, he's entitled to use the Section 199A deduction. His Section 199A deduction would be 20% of $100,000. Now, there are some income restrictions. There are limits imposed on this 20% deduction based on how much the owner makes in taxable income. Thresholds are set at the following amounts. For an individual, $157,500, as we've already discussed. Married, $315,000. And the thresholds are based on each business owner's income level, not on the total taxable income of the business. Comment on this. We need help from the IRS to better define what is considered taxable income for purposes of these phase-out thresholds. As of right now, it seems that taxable income will be defined as the taxpayer's own taxable income, not AGI, less deductions. If the owner's taxable income is below this threshold, then the calculation is a simple 20% deduction of any pass-through income. If the owner's taxable income exceeds those thresholds, then we have some work to do in order to calculate the qualified business deduction. Continuing with our discussion of the qualified business income deduction, let's look at reasonable compensation and guaranteed payments. QBI doesn't include any amount paid by an S corporation that's treated as reasonable compensation to the taxpayer. QBI doesn't include any guaranteed payment for services rendered with respect to the trade or business. QBI doesn't include any amount paid or incurred by a partnership to a partner who is acting other than in his or her capacity as a partner for services. For example, Stephanie is a shareholder in and a sales manager for RFS, an S Corp that under IRS rules is a qualified trade or business. During the tax year, she receives reasonable compensation of $250,000 from RFS for her services as its sales manager. In addition, her pro rata share of RFS's net income, its only item of income or loss, is $175,000. Stephanie's qualified business income, or QBI, from RFS is $175,000. This is the amount that's eligible for the 20% QBI deduction. Talking about calculating the QBI deduction for a trade or business, the QBI deduction for a qualified trade or business is the lesser of 20% of qualified business income or the greater of 50% of the business's W-2 wages, and this applies to most businesses, or an amount based on a more complex formula involving the business's W-2 wages and depreciable property. The amount in number 2 above is referred to as the W-2 wage limitation. For example, Harold, a single taxpayer, owns and operates a sole proprietorship that sells textbooks. The book business pays $100,000 in W-2 wages and has $350,000 in qualified business income. For the sake of simplicity, we'll assume the business has no depreciable property, so the W-2 wage limitation is based on 50% of the business's W-2 wages, not the more complex formula involving wages and property. Harold's QBI deduction, $50,000, which is the lesser of 20% of $350,000 in qualified business income, in this case $70,000, or 50% of $100,000 of W-2 wages, which is $50,000. The W-2 wage limitation does not apply to individuals with taxable income of less than $157,500 or $315,000 for joint filers. After an individual reaches the threshold amount, the W-2 limitation is phased in over a range of $50,000 in taxable income and $100,000 for joint filers. Now let's look at some qualified business income deduction rules. The deduction is taken below the line. It reduces taxable income, but not adjusted gross income. The deduction is available regardless of whether a taxpayer itemizes deductions or takes the standard deduction. The deduction can't exceed 20% of the excess of taxable income over net capital gain. And if QBI is less than 0, it's treated as a loss from a qualified business in the following year. Let's take a look at above or below the line. What does that mean when we refer to above the line or below the line? This 20% deduction will be a below the line deduction, which is important. It's an important piece to understand. Tax lingo makes my head spin as well. So let's pause for a second to understand the difference between an above the line deduction and a below the line deduction. The line refers to the AGI line, the adjusted gross income line on your tax return, which is the bottom line on the first page of the 1040. While both above the line and below the line deductions reduce taxable income, it's important to understand the difference between the two. Above the line deductions happen on the first page of your tax return. These deductions reduce your gross income to eventually reach your adjusted gross income for the year. Above the line deductions include contributions to health savings accounts, contributions to retirement plans, deductions for 1/2 of the self-employment taxes, health insurance premiums paid, alimony paid, student loan interest, and a few others. The AGI is important because the AGI is used to determine your eligibility for certain tax credits. It will also determine for which below-the-line deductions you're eligible. In general, the lower your AGI, the more deductions and credits you're eligible to receive. Looking at below-the-line deductions. Below-the-line deductions are reported on lines that come after the adjusted gross income calculations. They're comprised mainly of your standard deduction or itemized deductions and personal exemptions. Now, most of these personal exemptions will be gone starting in 2018. The 20% deduction for qualified business income will fall into this below-the-line category. This is why we're talking about it. It will lower the income of small business owners, but will not lower their adjusted gross income. There's a taxable income limitation on QBI deduction. If your taxable income reduced by any income taxed at capital gains rates and before applying any QBI deduction is less than your qualified business income, the QBI deduction is limited to 20% of your taxable income reduced by any income that gets taxed at capital gain rates. For example, Denise owns and operates Hiker Hostel, a sole proprietorship that's a qualified trade or business. Denise has $100,000 in qualified business income from Hiker Hostel and no other items of income or loss. She has a total of $25,000 in above-the-line and itemized deductions. Her taxable income before applying any QBI deduction is $75,000. Cynthia's QBI deduction is $15,000. This is the lesser of her QBI deduction for Hiker Hostel, which is $20,000 or 20% of the $100,000, or 20% of her taxable income taxed at regular tax rates. In this case, $15,000 or 20% of $75,000. Finally, more qualified business income deduction rules. For taxpayers with taxable incomes above $157,500 or $315,000 for joint filers, an exclusion from QBI of income from specified service trades or businesses is phased in. These are trades or businesses involving the performance of services in the fields of health, law, consulting, athletics, financial or brokerage services, or where the principal asset, once again, is the reputation or skill of one or more employees or owners. A comment on this. So what does this mean? Well, there will be restrictions on the 20% deduction for pass-through entities that are considered a service business under Internal Revenue Code Section 1202. In a last-minute change to the regulations to their favor, engineers and architects were excluded from the definition of service businesses. This is another gray area. Many small businesses that fall outside of the categories listed will undoubtedly be asking the question, am I considered a service business or not? Outside of the industries specifically listed in the tax bill, we really need more guidance from the IRS. If taxable income is at least $50,000 above the threshold, for example, $207,500, all of the net income from the specified service, trade, or business is excluded from qualified business income. Joint filers would use an amount $100,000 above the $315,000 threshold, in other words, $415,000. The amounts listed, $157,500 for individual and $315,000 for a married couple filing joint, are where the thresholds for the phase-out begins. The service business owners whose income rises above these thresholds will phase out of the 20% deduction over the next $50,000 of taxable income for individual filers and $100,000 of taxable income for married filing joint filers. This means that the 20% pass-through deduction is completely gone by the following income levels. For an individual, $207,500. For married, $415,000. Any taxpayers falling in between the threshold and the phase-out limit will receive a portion of the 20% deduction. If taxable income is between $157,500 and $207,500, exclude only that percentage of income derived from a fraction. The numerator of this fraction, or the top, is the excess of taxable income over $157,500, and the denominator, or the bottom part of the fraction, of which is $50,000. In other words, taxable income minus $157,500 divided by $50,000. If taxable income is $167,500, or $10,000 above the $157,500 threshold, 20% of the specified service income would be excluded from QBI. For joint filers, same operation would apply using the $315,000 threshold and a $100,000 phase-out range. For example, taxable income, $167,500, base amount for single filer, $157,500, the amount over the base, $10,000, the percent of QBI, qualified business income excluded, $10,000 divided by $50,000, or 20%. Potential QBI, $100,000. So the exclusion from QBI, in this case, $20,000, or 20% of the $100,000. Adjusted qualified business income, $100,000 minus $20,000, $80,000. The deduction at 20%, $16,000. Number 3 in our top 10 list of things you need to know about the Tax Reform Act: limitations on business interest deductions. The deduction for business interest is limited to the sum of business interest income, 30% of the adjusted taxable income of the taxpayer for the taxable year, and the floor plan financing interest of the taxpayer for the taxable year. Business interest not allowed as a deduction for any taxable year may be carried forward indefinitely beyond the year in which the business interest was paid or accrued, treating business interest as allowed as a deduction on a first in, first out, or a FIFO basis. The definition of business interest means any interest paid or accrued on indebtedness properly allocable to a trade or business. The definition of adjusted taxable income. This means the taxable income of the taxpayer computed without regard to any item of income, gain, deduction, or loss which is not properly allocable to a trade or business, and any business interest or business interest income, and the amount of any net operating loss deduction. Now, we just mentioned floor plan financing interest. What does that mean exactly? Well, floor plan financing indebtedness means indebtedness used to finance the acquisition of motor vehicles held for sale or lease to retail customers and secured by the inventory that's so acquired. A motor vehicle means any self-propelled vehicle designed for transporting persons or property on a public street, highway, or road. Number 4 on the top 10 list, limitations on losses for taxpayers other than corporations. For taxable years beginning after December the 31st, 2017, and before January the 1st, 2026, excess business losses of a taxpayer other than a corporation are not allowed for the taxable year. These losses are carried forward and treated as part of the taxpayer's net operating loss, or NOL, carry forward in subsequent taxable years. An excess business loss is defined as the excess of aggregate deductions of the taxpayer that are attributable to trades or businesses over the sum of aggregate gross income or gain of the taxpayer, plus, once again, a threshold amount initially set at $500,000 for married individuals filing jointly, or $250,000 for other individuals. Under the new law, NOL carryovers generally are allowed for a taxable year up to the lesser of the carryover amount, or 80% of taxable income, determined without regard to the deduction for any net operating loss. The threshold amount will be indexed for inflation. In the case of a partnership or an S-corp, the provision applies at the partner or shareholder level. Each partner's distributive share and each S-corp shareholder's pro rata share of items of income, gain, deduction, or loss of the partnership or S-corp are taken into account in applying the limitation under the provision for the taxable year of the partner or S-corp shareholder. Number 5 on the top 10 list of things you need to know about the Tax Reform Act: changes to the home mortgage interest deduction. The new law provides that, in the case of taxable years beginning after December 31st, 2017, and beginning before January the 1st, 2026, a taxpayer may treat no more than $750,000 as acquisition indebtedness, $375,000 in the case of married taxpayers filing separately. In the case of acquisition indebtedness incurred before December 15, 2017, this limitation is $1 million, or $500,000 in the case of married taxpayers filing separately. As of 2018, a deduction is no longer allowed for interest on home equity indebtedness. Existing home equity loans are not grandfathered. Number 6, the estate and gift tax, looking at 2018 and beyond. The new legislation doubled the estate and gift tax exemption for estates of decedents who passed away after December 31st, 2017 and before January the 1st, 2026. Also, the exemption was doubled for gifts made after that same time period. The basic exclusion amount provided in Section 2010C3 went from $5 million to $10 million. The $10 million amount is indexed for inflation occurring after 2011. And take note, for 2017, the estate and gift tax exemption is $5.49 million per individual. Number 7, a change to the deduction for taxes not paid in a trade or business. The Tax Cuts and Jobs Act provides that in the case of an individual, state, local, and foreign property taxes, as well as state and local sales taxes, are allowed as a deduction only when paid or accrued in carrying on a trade or business, or carrying on an activity relating to expenses for the production of income. In the case of an individual, state and local income, war profits, and excess profits taxes are not allowable as a deduction. Listed below, the provision contains an exception to the above stated rule. A taxpayer may claim an itemized deduction of up to $10,000 or $5,000 for a married taxpayer filing a separate return. This deduction is the total of state and local property taxes not paid or accrued in carrying on a trade or business, or an activity described in Section 212, and state and local income, war profits, and excess profits taxes or sales taxes in lieu of income taxes paid or accrued in the taxable year. An individual could not have claimed an itemized deduction in 2017 on a prepayment of income tax for a future taxable year in order to avoid that dollar limitation, that $10,000 limitation that's applicable for taxable years beginning after 2017. The IRS said that a full deduction for the prepayment of state or local property taxes depended on whether the taxpayer made the payment in 2017 and whether the property taxes are assessed prior to 2018. A prepayment of anticipated real property taxes that haven't been assessed prior to 2018 is not deductible or was not deductible on 2017 tax returns. State or local law determines whether and when a property tax is assessed, which is generally when the taxpayer becomes liable for the property tax that's imposed. Number 8. Changes to the deduction for casualty losses. The new law temporarily modified the deduction for personal casualty and theft losses so that a taxpayer may claim a personal casualty loss only if such a loss was attributable to a disaster declared by the President under Section 401 of the Robert T. Stafford Disaster Relief and Emergency Assistance Act. The provision is effective for losses incurred in taxable years beginning after December 31st, 2017, but doesn't apply with respect to losses incurred after December 31st, 2025. Number 9. Changes to the deduction for medical expenses. The new law provided that for taxable years beginning after December 31st, 2016 and ending before January 1st, 2019, the threshold for deducting medical expenses is 7.5% of adjusted gross income for all taxpayers. Starting in 2019, the 10% threshold will apply to all taxpayers. Obamacare isn't going away quite yet. As we recently heard in the news, the Republican Party tried last year to repeal and replace the Affordable Care Act. Although their health care push fell short, they were able to insert language into the new tax reform bill to eliminate the Affordable Care Act's individual mandate, which is the clause that financially penalized taxpayers if they didn't sign up for health insurance. However, the individual mandate doesn't end until 2019, so don't go dumping your health care just yet. And number 10, repeal of the deduction for alimony payments. The new Tax Reform Act provided that alimony and separate maintenance payments are not deductible by the payor spouse. The new law repealed the code provisions that specified that alimony and separate maintenance payments were included in income. Income used for alimony payments is taxed at the rates applicable to the payor spouse rather than the recipient spouse. The tax treatment of child support has not been changed. The new law is effective for any divorce or separation instrument executed after December 31st, 2018, or for any divorce or separation instrument executed on or before December 31st, 2018, and modified after that date if the modification expressly provides that the amendments made by this change apply to such a modification. So how much will the new Tax Cuts and Jobs Act save us? It depends on what your income level is, how much comes from traditional employee work or investment income, and other factors such as child dependence. It's been estimated that a typical taxpayer earning $40,000 to $50,000 per year will save around $1,000 to $2,000 per year, the higher number for taxpayers who have children. Those with higher income, business owners, and those with significant investment income are projected to see the biggest tax cuts, since the bill was intended to spur economic growth. If you'd like to read the bill itself or delve into the tax reform a little further, log on to the website fairandsimple.gop. We want to thank you for watching this TaxSlayer Pro presentation of 10 things you need to know about the Tax Reform Act.